Hello, everybody. Ed Yardeni here. It's October 6th. It's Monday. It's 11 a.m., and we're having lots of fun, aren't we? Well, first of all, importantly, let's start with the weather here in Long Island. It's beautiful. It's really just totally bizarre. It's like living in California for the past month, and here it's October, and we're still talking about 80 degrees as the weather, and very, very sunny, not a cloud in the sky. So it's been a hot streak, and it's been a hot streak in the stock market. Just an extraordinary move here that just continues. And right now, all the talk is about whether this is a bubble. As I wrote in my quick takes just recently, we got a bubble in bubble fears, concerns that this is all going to end badly. It might. I did raise my. I went back to 7,000 on the S&P 500 by the end of the year. That's where I started the year. But along the way, I did write and say a few times that I reserve the right to change my mind as often as the president seemed to be changing his mind about what he wanted to do with tariffs and Doge and all that. But I've always believed that it's a bull market, still a bull market, and I think it's still got upside potential. I think what the stock market is discounting is the resilience of the U.S. economy. For the past 4 years almost now, we've had this fear that we're going to have a recession. Again, I've described it as the most widely anticipated recession of all time that just didn't happen. Maybe now that nobody expects a recession, we have to worry more about that possibility. But it certainly shows that despite all the shocks that the economy has been exposed to, it's continued to grow. The last recession we had was a 2-month recession back in 2020, and it was sort of a man-made recession. It was a 2-month downturn related to a 2-month lockdown in response to the pandemic. And then when the lockdowns were lifted, we still had social distancing requirements, which continued to weigh in the economy, and yet the economy continued to grow. Then we had the supply side disruptions, which led to a surge in inflation, which led to a surge in monetary tightening. And that did not cause a recession either, much to the surprise of just about everybody. We weren't in that camp. We said that everybody was focusing on the monetary cycle, the business cycle, and we were focusing on the credit crisis cycle. And we argued that, yeah, we could get a credit crisis, but we're probably not going to get a credit crunch. And if we don't get a credit crunch, we're not going to get a recession. And besides, I said that we have recessions. They're just kind of rolling recessions that are hitting the economy in different places at different times, but not adding up to an economy-wide recession. So following the tightening of monetary policy, the Fed went on pause. Last year, it started to ease at the end of the year. Bond yields went up instead of down, as the Fed, much to the Fed's surprise. And same thing's happening now. They just won't listen to us. I mean, we said that if they lowered the Fed funds rate again, they might have a repeat of what happened last year, where the bond yield goes up. And last I looked, it's up from 4% to 4.16%. Just isn't acting as though Fed easing is viewed as a positive, especially when you consider that there's debt crises going on right now in France, another political upheaval. What a day today was. We have France in an upheaval, AMD and OpenAI. We've got gold at a record high. And then we've got a merger, an acquisition in the financial sector, which probably harbingers a lot more coming. So that's where we are. We're in a resilient economy that's withstood a bunch of shocks. After the shock of the Fed tightening, we had tariffs. Now we have what do we have now? I guess we've got concerns about the Supreme Court maybe blowing away at Trump's tariffs, or saying they're not constitutional, and giving him maybe some time to get legislation out of Congress to validate it. But a lot of shocks, and yet the economy continues to roll on. Oh, I should have mentioned the most important shock of late has been the shock in the labor market. I mean, that's kind of important. How can we talk about a resilient economy when the labor market seems to be so weak? And we keep working on it. It's a valid point. Maybe this is what happens as we get a employment-led recession that finally takes this economy down. But we also know that there's a lot of funky things going on in the labor market. On the supply side, the population of foreign-born people is down 1.9 million just from March to August. We don't have September data because of the government shutdown, but from March to August, the population of foreign-born is down 1.9 million, and the labor force impact, the supply of labor, the labor force is down 1.5 million for the foreign-born. So that's clearly having an impact. And by the way, if you're an employer and you hired people without documentation, you might have major second thoughts about doing that now, and you might be actually looking to replace your undocumented workers with people who are legitimately here and can work without suddenly being pulled away by an ICE raid. So, I mean, that's a real concern, I think, for some businesses, obviously, not many, I presume. But what else do we have here in the labor market? Well, we're saying that AI may very well be having an impact on entry jobs. I wrote the story about Bonnie, the Uber driver that I ran into in Austin, Texas 2 weeks ago, and kind of discussed her woes at having worked for the tech industry in Silicon Valley for something like 6 years, being fired twice, and now moving to Austin, hoping she'd find a tech job there, and instead she's driving an Uber. And she blamed her woes on AI, and she said the only interviews she can get are interviews for entry-level jobs. As she said, that people she knows that don't have as much of experience can't even get an interview. So there's definitely something going on here where companies are assessing whether AI can, in fact, increase their productivity, which means that they don't need as many workers. And if that's the case, then they're probably holding off on hiring. By the way, this idea that we're in an economy where there's no hiring and no firing going on, I think is a misconception. The reality is, in August, according to JOLTS, 5.1 million people were hired. It just happened that that exactly equaled the 5.1 million people that were separated from their jobs either by layoffs or by quits. And so we are still at the full employment economy. When you look at it that way, the unemployment rate is still extremely low at 4.3%. It's just that in the past, we're used to, during economic expansions, we're used to seeing that hires exceed separations, and that difference tends to be pretty close to the payroll employment change that we used to get in the good old days before the government shut down. But that's the story. So the question is whether the apparent weakness in the labor market is a demand phenomenon or a supply phenomenon. It's probably some combination of the two. But the Fed, based on its dual mandate, says, well, our job is to keep inflation down, and we think we're getting there. We're at 3%. We think we've stalled out at 3% on a transitory basis. We think once the tariffs are fully incorporated, the thinking at the FOMC goes, we'll get down to 2%. And I agree with that. I've said that I don't think that tariffs increased inflation. They stalled inflation at 3%, and it would have been on its way to 2% if it wasn't for the tariffs. And I think that we are looking at lower inflation. I know that I heard that Citi raised their inflation outlook for the year or two ahead. But I'm still in the roaring 2020s camp. I believe that a lot of what's going on in the labor market, the shortage of workers, the skills mismatches, are forcing employers to improve their productivity, and productivity is a dramatic magic wand. It means that economic growth can be faster. It means that if you don't have consumers' headcount increasing, because the job market isn't creating more jobs, you can still have real wages going up, which is what provides purchasing power. I've also mentioned that the savings rate is probably going to continue to decline. It's been declining for the past few months. We think it's going to turn negative over the next couple of years as the baby boomers retire. They're not going to get paychecks, but they are going to spend out of their net worth, and that's going to continue to give resilience to the consumer. So we've got a consumer that looks pretty good, despite the fact that the labor market's not doing too well. But it is certainly a weak point in our argument right now in terms of the labor market concerns. The Fed again lowered the rate by 25 basis points. The bond vigilante said, well, for a while they're getting excited about the Fed cutting rates, and the yield came down from kind of the bottom end of our range of 4.25% to 4.75%. We think that's normal. We think that's where we are going to be going into next year. So we're below that right now on Fed easing, but the bond market's definitely having some second thoughts here about what Fed easing is all about. We know what it's about. It's an old Keynesian trick, and that is lower interest rates, ease monetary conditions, you'll get more demand, and if you get more demand for goods and services, you'll get more demand for labor. Well, I think we all recognize that there's some issues here that may not pan out according to that script, and that is lowering interest rates to stimulate demand in an economy that's red hot. When you look at GDP was revised from 3.3% to 3.8% seasonally adjusted annual rate for the second quarter. That's hot. Yes, I know the first quarter was negative, and so we had this tariff funkiness happening to the statistics, which then meant the second quarter went up. But it went up a lot more than it went down in the first quarter, and consumer spending was actually revised up. Capital spending is all-time record high, very strong, as is consumer spending. So we have a situation then where the Fed is lowering interest rates to stimulate demand, which is already strong, and that increase in demand may not lead to any improvement in the labor market situation. We still may get weak payroll employment, and the reason for that is because the problems are structural in nature. On the supply side, with the drop in foreign-born, with the baby boomers retired, and on demand side, with AI and just lowering interest rates, isn't going to make a difference to the economy, but it could make a difference to the financial markets. And we did raise the odds of a meltup in the quick takes that you might have seen, and now we're looking for 7,000, back to 7,000 on the S&P 500 by the end of the year. And I guess what the way we get there is still not in a bona fide meltup. We're keeping the PE, the forward PE at 22, and instead of $300 a share for the S&P 500 as the forward earnings number at the end of this year, which in other words, instead of the market anticipating $300 a share next year, by the end of the year, we think the market is going to be anticipating at the end of this year, we think the market's going to be anticipating $310 a share. That may sound like a stretch, but we're already at $304 a share as the analyst consensus expectations for next year. So, the big story we've been saying is that this actually has been an earnings-led bull market. It's just been a bull market where the PE is extremely high, but following the pandemic, when we fully recovered what we lost during the lockdowns, if you go from there, the market's up. That's about, I think it's during the summer of 2020. We now see that the market is up 100%, and forward earnings are up 100%. So far so good. But we're moving here on the PE. Last I looked, the PE was no longer at 22, but heading towards 23. And to me, a melt up would be we get to 25, and then we might have a correction. Look, just because it might be 1999 all over again, it's not exactly 1999, and it doesn't necessarily follow that we have to have a bear market or even a recession like we had in 2000, 2001. So that's kind of where I'm coming from. Corrections happen, bear markets happen. We view them as buying opportunities. Uh, the last the bear market we had was in 2022. It really didn't last very long. It was painful. It didn't last very long. And it turned out to be a great buying opportunity. We had a pretty significant correction at the beginning of this year, and it was a buying opportunity. So we'll see what's ahead here, but we're sticking with the roaring 2020 scenario. Let's have a look at some charts, and then hopefully I'll leave some time for a little discussion with you folks. Okay, here we go. So this is just charts that confirm some of the points I've been just making. Stock market all-time record high, kind of elevated relative to its 200-day moving average, kind of consistent with where the market was going before the correction. This correction was deep seek combined with tariffs. The president decided to postpone Liberation Day on April 8th, the April 9th, I should say. Market soared 10%, kind of retested, didn't go back down to its lows. And here we are making record highs without a lot of volatility. So that's all pretty impressive. NASDAQ, the same story. We're kind of back to, never mind, forget all this. This was a great buying opportunity, but other than that, the bull market continues. I kind of believe that the bull market has been around for a long time. I think it kind of started over here when we had this V-shaped recovery following the pandemic lockdown. Then we had this bear market, which was a phony bear market. Bear markets are only supposed to occur when a recession is expected to happen and it actually happens, but that wasn't the case. And then, so in some ways, this kind of feels like one big bull market with some buying opportunities along the way. But then, I tend to be a glass half full kind of guy. Real GDP, again, from this perspective, look at this a ratio scale so we can kind of see where it's going and comparable percent changes. And you can see we had this recession back here, this significant recession during the financial crisis. But I would say that the economy has basically been growing since here. This was just a lockdown, and it was a painful recovery in the labor market and all that. But when you look at it from a GDP perspective, this was just kind of a blip, and the economy has continued to roar ahead. And now we're talking about not only the roaring 2020s, but the roaring 2030s. And now look at all the shocks that this economy has withstood, and it's still punching away. This is the shock of the supply chain disruptions. So this was the shock of the lockdowns. This was a shock of the supply chain disruptions, leading to a big surge in the CPI inflation rate led by durable goods inflation. And then as the supply disruptions, we use the FRB New York Global Supply Chain Pressure Index as an indicator for that. Then another shock here. Well, this is the same shock, really. This is the durable goods inflation back in 21, 22. Then it moderated. And now we have the tariff shock pushing durable goods inflation up again. And yet the economy is still rolling along. We had the shock of the Fed deciding that, well, maybe they were a little late on dealing with the inflation shock. So they raised interest rates dramatically. We argued that going from 0 to 5.5% wasn't just tightening; it was also normalizing interest rates, particularly the bond yield, which went from 0.5% over here to what we think is a more normal level of 4 to 5%. Fed paused, as I said, then the Fed eased, and the bond yield went up 100 basis points. and now we see kind of a similar situation right now. This is the weak the weak part of the story, and presumably we've seen a dramatic change in the change in the monthly change, the average monthly change in the 3 month ADP numbers has certainly shown a significant slowdown, as has the payroll employment. I mean, this slowdown has coincided with much more economic uncertainty. It's coincided with the tariffs, with the Doge. Maybe that has something to do with it. And of course, it's coincided with the shutting of the southern border and deportation. So that may very well be a factor. And at some point, AI is going to have an impact on boosting productivity, which could mean that entry-level jobs, at least, will be harder to find. And maybe we're there. Meanwhile, the good news is that if we're not going to increase the headcount of consumers, because we're not going to be very much, and if we're not going to be increasing, because we're not going to increase the headcount of workers, then we need something to keep the consumer growing. And productivity should do the trick. This is productivity on a level basis versus hourly compensation divided by the deflator. So it's real compensation, wages and salaries, including benefits and the whole, all that stuff. And if it wasn't for this aberration here, we'd be at a record high on real purchasing power. Here's another measure of real purchasing power. It's inflation-adjusted average hourly earnings. Again, if you just take this aberration out, we're at a record high there. And it's not just the high-income people that are doing well. High-wage workers actually did not do very well there for a while during the pandemic. Now their wages are starting to increase again. But production and non-supervisory workers, who account for about 80% of the labor force, and they're not high-wage workers. This is what they're getting, actually. As you can see, $25 per hour. The uppers are getting $45 per hour. The average is more like $29 an hour. But this has been an upward trend. Real wages have been increasing, notwithstanding the progressives' claim that workers' pay has been stagnating for decades. Personal savings rate, well, again, the baby boomers retire. I think this is going to turn negative, and that'll keep consumer spending going. I saw that there's Moody's did a study that 10% of consumers do 50% of consumption. I got to do some work on it. It just doesn't make sense to me that number is even close to reality. I'm not saying that the higher income, wealthier people aren't spending a lot more than lower income, but there aren't that many of them compared to lower income. So that number just doesn't make much sense to me. Meanwhile, this is the savings rate on an inverted versus the inverted ratio of net worth to disposable income. The wealthier the household sector gets, the lower you would expect the savings rate would be. So here's what's going on in the labor market. We're seeing that the unemployment rate for teenagers has gone up. The unemployment rate over the past couple of years, the unemployment rate for people coming out of college recently, that's gone up. Everybody else is still running under 4%. So this may be an AI phenomenon or a skills mismatch. I mean, a lot of kids are coming out of college with the same kind of degrees and not with the skills that employers actually need. Here's what I said about the foreign-born, down 1.9 million for the population, down 1.5 million for the labor force. I'll concede the employment indicators are weak, kind of increasingly across the board. This is the employment numbers in the manufacturing PMI and NM And on the other hand, when you look at the overall MPMI, which is this one, looks pretty weak. But when you look at its relationship to real GDP goods has been actually pretty strong. So there's some divergence here that maybe some structural changes in the goods market. Still working on that one, trying to figure it out. And almost the same thing applies here. This is the PMI for the non-manufacturing sector, and it's got an okay correlation with real GDP services, but it's not science, it's not exact, and we're still sticking with the whole resilience story. Okay, so I left a little bit more time than usual. I do tend to maybe gab a little too much, but we got three questions so far. Let's see what I could do with them for you. Eric asks, Dr. Ed, how important is the long end of the Japanese government bond market to financial market stability, especially if the bond vigilantes protest new spending plans following elections? Thank you, Eric. Well, Eric, speaking of Eric Wallerstein, who was with me until May, moved on to, I don't know if it'll turn out to be greener pasture, but they're interesting pastures. He moved on to the Council of Economic Advisors. And when he left, I kind of scratched my head and said, okay, what do I do for an encore? So for an encore, Jackie Dougherty, who used to be at Barron's and has been writing us for years and does an outstanding job on Thursdays, particularly in disruptive technology, said, why don't you look up William Pesek, who used to be at Barron's, and now he's a freelancer working out of Tokyo. So William is our Tokyo bureau, if you will, and he knows Asia backwards and forwards. So he's been writing a lot about Japan. He'll have more to write about it this week with the elections. But the bond market matters over there. Bond market is a global bond market, but if bond yields go up in Japan because the bond vigilantes don't like what the new government's going to do, increase its deficits and debts, perhaps we'll see. There's supposed to be a conservative government, but there's some controversy about what they're actually going to do, and they do have to form a coalition. Then France's government, president at least, just resigned after a little over 20 days. So that's a mess, and the bond yields have gone up there, and the bond yields are going up in the UK. Maybe by comparison, the US doesn't look so bad after all, and they could be canaries in the coal mine and saying, okay, the debt crisis is next coming to the United States, but you could also read it the other way. I'm going to stick with 4.25 to 4.75 as kind of the right place for the bond yield. Could be wrong for a little while, right as I am right now, but I think it's coming back. The reason I don't think it goes to 5% and higher or very long at 5% is because the Treasury knows how to play yield curve control. Janet Yellen did that November 1st of 2023, told the bond vigilantes, okay, I'm not going to increase the amount of bonds that I issue. I need more money. I'll get it in the bill market, and that calmed the bond market down quite a bit. Bessent is fully capable of upping the ante and saying, I'll do more in the bill market. He's also gotten very excited about stablecoin and what that means in terms of creating more demand for bills. So there's still gimmicks that the Treasury can play, and even the Fed could play to try to offset the bond vigilantes. They're not all powerful. They matter, but the Treasury, the Fed matter. Foreign investors matter, currency matters. By the way, speaking of that, I'm a happy camper. It looks like the dollar may be actually finding some strength here. Maybe it's just a day or two, but it seems to have held down by its fingernails to the DXY level of an upward channel. So I think that'll continue to be the case. By the way, DXY, as I said before, is 50% euro. It's a fixed weight index. So it's basically the euro. And what's so exciting about the euro with the French government failing again, with Germany's economy getting hollowed out by Chinese competition? The UK is not in the euro, but it's got its issues. Cognis, I had 12-quarter annualized U.S. productivities are already up to 2% type level from low levels in the past few years. How much AI impact does this already have, you think? If not much, and when AI kicks in, what is reasonable to expect as peak productivity? Is 3 to 4% productivity possible? That kind of time horizon, you think? Cagnes, thanks for that question. We've been in that camp thinking that the roaring 2020s is all about labor shortages, skills mismatches, forcing companies to use technology, and there's more and more technology that's more useful in increasing productivity, particularly brain productivity as opposed to brawn productivity. I think we've gone about as far as we can with brawn productivity, though autonomous cars and and autonomous flying vehicles. Maybe that's kind of a Braun issue. But yeah, I think 3 to 4% is reasonable over between now and the end of the decade on a year-over-year basis at some point. And we think that that again that could occur before the end of the decade. So that's where we are, and that is the roaring 2020s. Adam, hey Ed, curious if you think there's a point where the government shutdown can drag the market down. Uh, Good question. Hip hip hooray, the government is shut. Yeah, we got to get this government open. We'll see how much pain the Republicans or the Democrats can stand. But the markets have been amazing, and that's because earnings have been amazing. I would say, I guess this could go on through the end of the month. And I think as we get closer to the holiday season, there's going to be more and more pressure on Washington to get its act together and open the government. So I think we can kind of grin and bear it for a couple of months. Beyond that, I think it has a significant negative impact on the economy, and it could therefore lead to some year-end correction in the market. But that's not my most likely scenario. Chip, with productivity offsetting weaker job growth, how might this structured divergence reshape wage dynamics, particularly for younger workers? Yeah, I mean, this all has all sorts of implications. I mean, I didn't really answer the question before about AI. I don't believe that AI really has kicked in yet. I mean, I'm using it as a research assistant, and it's increased my productivity somewhat, but I also have to reread it and double check it. So it's not a research assistant that I completely trust at this point. We are looking at ways to use AI just on our data that we've created. That means like our written work as a kind of a way to summarize some of the things we've written in the past and to find things more quickly. Um, and we are looking into it in terms of producing our economic calendar and analysis of the economic indicators. So we're looking at all that, but all that still requires a human with some intelligence to read it. Artificial intelligence AI is artificial. It's not intelligent, and so you still need an intelligent human. Uh, there is a lot of hype going on about AI, and this Sam Altman is right at the top of the list of hypesters. And you know, there is an uncomfortable feeling that we all have with the hype that's going on and the amount of monies that are being thrown about. And I'll put 10 billion in your organization over the next 5 to 10 years if you come back and buy my chips for 10 billion over the next over that time period. So we'll see how this plays out. But for now, the earnings look like they're still there. We're watching forward earnings. Forward earnings are all-time record high. That's our weekly indicator of economic activity. It tracks very well with real GDP, with the index of coincident economic indicators. So we're not completely flying blind here when it comes to indicators that we can use. Tomorrow, no, tomorrow? No, not tomorrow. Next week, we'll get the National Federation of Independent Business. That'll be worthwhile looking at. So interesting times. I don't remember them being quite this interesting in quite a long time, but right now, you know where we stand. We'll keep you posted on our thinking along the way. Thanks for tuning in to this weekly webcast. I was out in California last week, and I think I'm going to be around next week. So I'll see you next week live. Thank you, everybody. Have a good week.